What is going on, guys? Nick here, back with another video. Today I'm going to show you guys the top stocks on my watch list that I want to buy as the stock market continues to fall. Now, I've been reading a lot of social media posts about the drop that we've seen over the past month, and it seems like a lot of people are freaking out saying that the markets are going to zero, they're blaming the Fed, to even this guy, Jeremy Grantham, saying that stocks were in a super bubble which is now popping. Now, I get it, it's scary to see your account drop by 15 to 50% depending on what you've been investing in, but you really shouldn't let fear get the best of you. Times like these are the best time to buy stocks on the cheap. Imagine somebody comes to you every single day and tells you how much your car or your house or whatever else you own that's valuable is worth. Well, on Monday they say, hey, the house is worth $300,000, and on Tuesday they say it's worth $250,000. Would you respond by saying, okay, I gotta sell it now? Of course not. Doesn't make any sense. To me, what makes this even crazier is I keep track of the stocks that I own and what I think they're worth. For the most part, most of the blue chip stocks have been right around fair value. A few a little high, a few a little low. These super bubbles that people like Jeremy Grantham are talking about are total nonsense. Now, going over to Google and searching his name for articles between 2018 and 2019, it comes up with some articles where he makes the exact same claim just a couple years ago. In this article I found from January 4th of 2018, stock market investors should brace for possible near-term melt-up. Jeremy Grantham. In this article, he basically says that stock prices are going to rise really fast over the next 6 months to 2 years, and even if we give him all the benefit of the doubt and go all the way out to 2 years, the stock market only went up 19% over that time. If you were in the stock market in 2018, you would know that this was a pretty disappointing year overall. The US was in a big trade war with China, and that basically tanked the market by the end of the year. Well, Jeremy said that if there is a melt-up, which there wasn't, that the odds of the bubble break are very high and that the market would probably fall by 50%, which seems kind of obvious. If stocks suddenly jump up by a whole lot for no particular reason, it seems pretty obvious that there's a good chance that they could fall back down by the same amount. So listen, guys, I have this clock right here that actually sits right by my desk. Right now the batteries are dead, but at least twice a day it's right. And this is kind of the same thing for Jeremy Grantham. Yeah, the market has fallen over the past week, but if you're always telling us that the super bubble is about to burst, and always telling us that the market is so high and it just continues to go up for years, I think it's hard to find you really that credible. Now, the good news is, if you do want to find stocks at really good prices, now is a great time. Now, there are some people who are going to want to try to time the bottom, but timing the bottom is all about luck, and I just don't really see it as something that you can predict. So what you should be doing is finding undervalued stocks and either adding to that position or starting a new one. For me, back in March 2020, I found Penn at what I thought was a trailing PE of around 2. I ended up buying it at $6 a share and then at $4 a share before the stock ended up turning around. Now, I didn't know when the stock would rebound, but I did know it was hilariously cheap. And these are the things that we should be looking for. Now, I haven't found anything quite that good yet, but I'm definitely going to be looking for it. And if I find anything, I'll certainly let you guys know. But I hope all of that helps give you some confidence to buy the dip. So this video isn't going to be in any particular order, but I am going to start with some pretty obvious no-brainers. I think if you don't already own these stocks, that you've definitely been missing out, but now is a great chance to add them to your account. So the first stock is Google. I'm pretty sure you guys all know about Google already, but this company has had some of the craziest earnings growth that I've seen in a while. On top of that, they have one of the best balance sheets out there with an insane pile of cash worth $142 billion and only $27 billion in debt. When we look at Google's forward earnings estimates, nobody is projecting a slowdown in growth in the near future, with the company growing its current $220 billion in revenue and $62 billion in profits to $334 billion in revenue and $88 billion in profits. $88 billion. That is a lot of profit. The historical and projected revenue growth sees Google maintaining a very high amount of growth, with the current forecast showing 17 and 15% going forward, which is really insane for a company already making $220 billion right now. If we value Google with a bottom end growth rate of 14% and a top end growth rate of 18%, that gives us a fair PE value between 31 and 45. But looking at macrotrends.net, it does seem like they typically trade with a lower PE, somewhere between 23 and 31. Now, if we value them with the multiples that I think the company should be worth, we can see that it is way undervalued even over the past year, at least based off the growth that they've already been able to achieve. I'm projecting the company to hit a top-end valuation just under $6,000 by 2023. However, when we use its historical PE range of 23 to 31, we can see that the stock is around the low end of its fair value range between 2,400 and 2,300. But if you think long-term and you buy and hold, you should be able to expect somewhere between 3,000 to 4,100 by 2023. Now, stock number 2 is Meta, or Facebook. Now, I know Meta or Facebook is a pretty controversial company and people love to hate on Mark Zuckerberg for the most likely to turn out to be a robot, but Facebook is still one of the best online advertising platforms around, with last year seeing $112 billion in revenue and $40 billion in profits. For a lot of advertisers, there really just isn't a better return on investment than Facebook, especially for small and local businesses. When we look at Facebook's balance sheet, we can see that they aren't sitting on as big of a pile of cash as Google, but it is still a huge amount of cash with $60 billion on hand. And when we look at that little red bar, we can see just how low their debt is in proportion to their cash. So overall, Facebook is an extremely healthy company. Now, the current projections for Facebook's growth show no sign of slowing down, with 2023 bringing in $164 billion in revenue and $47 billion in profits. Again, these are really insane numbers. When we look at their revenue growth, we can see that they are slowing down, but they're still growing at very high numbers at 19 and 17% over the next 2 years. Now, Facebook should be worth a growth rate between about 14 to 19%, which gives us a fair PE value between 31 and 49. But we can see on macrotrends.net that it usually trades pretty close to Google's value between 23 to 31. So using that historical PE ratio, we can see that Facebook is trading way lower than it should. The stock should be worth somewhere between 320 and 434 per share, and by 2023 we should see a stock price between 388 and 523 per share. Now, stock number 3, this is the first one that I didn't find that was on my watch list. It's Camping World Holdings. Now, this is a much smaller company than what I typically look at, of only $2 billion in market cap. But this stock has sold off way too far because right now it's trading with only a PE of 5 and a forward PE ratio of 4. Now, Camping World Holdings sells used and new RVs and provides parts and services for those vehicles. Now, looking at the revenue and net income growth, we can see that they do have very slim profit margins, but we do see over the past 2 years that they have been profitable, even if it's only slightly. Now, looking at their balance sheet, it doesn't look great, with their debt about 4 times their equity. However, this seems to be just because their assets to liabilities is fairly close, giving them only a narrow amount of equity. And that debt that they have is only about $1 billion in total, and last year they took in $266 million in profit, so I don't really think that this is that big of a concern at this point. Now, looking at where their revenue and profits come from, the majority is generated from new RV sales, with used coming in second for revenue. However, their finance section actually brings in a pretty good amount of their profits with no actual operational costs. Now, looking at their projected revenue and earnings, Camping World Holdings is projected to grow all the way from $6 billion in revenue and $266 million in profits to $8.3 billion and $565 million in profits by 2023. Now, the revenue chart is very up and down, to say the least, but I think valuing them with a growth rate between 2 to 8% is pretty fair to me. A growth rate of 2 comes out to a fair PE value of 10, and a growth rate of 8 comes out to a fair PE value of 18. So looking at this valuation charted out, while it's not growing quickly, it does seem like the stock is just way too cheap compared to what it should be worth. And honestly, a PE of 5 is pretty insane. Even if this isn't one of the most incredible businesses out there, it is still way cheaper than it should be. Now, back to my watch list, stock number 4 is Ford. Ford has seen a pretty good start to 2022, jumping all the way from $20 to $24 per share before it ended up falling back down. Now, Ford as a company has really struggled over the past decade with a declining brand and difficulties finding ways to actually grow, since they've been selling 2.6 billion cars a year. However, the pandemic and EVs brought some changes to the car business as a whole. First, it became really difficult to build new cars because of the global semiconductor shortage. While demand has seemed to mostly rebound for vehicle purchases in 2021, the supply hasn't returned because of the semiconductor shortage and the lack of new cars. And this has driven up used car prices, causing a lot of the inflation numbers that we've seen. On top of this, Ford has transitioned to selling electric vehicles, which provide higher profit margins, and they've also prioritized building and selling vehicles with higher profit margins in general. So even though Ford is selling less vehicles, they're able to increase their profits. Now, Ford has a really exciting F-150 Lightning, an all-electric vehicle that they've had to stop taking pre-orders on at 200,000 trucks reserved. On top of this, they've also revamped the old Ford Bronco, as well as a new smaller pickup, the Ford Maverick, which actually only sells for around 20,000 right now, although I'm not really sure how I feel about the look. Now, when we look at Ford's revenue and net income, we can see how they took a pretty big dip in 2020, and over the last year, with much less revenue than any of the past 10 years, Ford still managed to turn a profit. Now, looking at the revenue growth, they are projected a pretty strong rebound over the next few years, all the way out to 2023, growing from $134 billion in revenue and $2.8 billion in profit to $165 billion in revenue and $9.4 billion in profit. Looking at the revenue growth, I think that these next couple years aren't the best measure to price Ford, so I think I'd rather stick with the 3% growth rate at the bottom end range and 7% for the top end range, which gives us a fair PE value between 11 to 17. Looking at this valuation charted out, going forward, Ford has a 2023 upside of 26 per share on the low end and an upside of 95% or 40 per share by 2023. Now, stock number 5 is another one that I've talked about a few times. It's CVS. CVS stock has really traded sideways for a while. The company definitely doesn't seem like a very exciting stock, but the reality is they've become a juggernaut of the healthcare industry. They already are the largest pharmacy chain in the US, and in 2018 they made a huge move when they acquired Aetna for almost $70 billion in cash. This gives CVS the opportunity to create a vertically integrated pharmacy company where they can still reduce the cost to fill prescriptions covered by their own insurance in their own pharmacy. They're also working to build out a bunch of quick care centers called health hubs in their stores where customers can quickly get treated for minor issues. Now, CVS, the company, has performed really well, and we can see that there's been a big jump from 2018 to 2019. But this is mostly the boost from Aetna's added sales and profits. Now, we do see that their profit margins are fairly slim, but CVS is consistently profitable. Looking at their balance sheet, we can see that CVS does have a lot of their liabilities reflected as debt, but their debt is still in a pretty decent position, especially after making that $70 billion purchase just 4 years ago. Right now, their debt is just slightly higher than their equity. Now, when we look at their forecasted earnings, we can see that CVS is projected to show a pretty good amount of growth from $285 billion in revenue and $7.5 billion in profit, all the way up to $319 in revenue and $11.7 billion in profits by 2023. When we look at this revenue growth charted out, we can see that CVS has been fairly steadily growing around 4 to 8% over the past few years. A growth rate of 4% gives us a fair PE value of 12, and a growth rate of 8% gives us a fair PE value of 18. However, when we look at macrotrends.net, we can see this is actually a little bit lower than where they typically trade at, which is around a PE of 14 to 21. So using my conservative valuation, we can see that if it does trade at a PE of 12, it doesn't have as much upside. However, it seems pretty rare for that stock to trade this low. So very easily by 2023, we should see an upside of at least 161 for CVS's stock. If we use their historical PE ratios, this would mean that CVS is trading much cheaper than it typically does, with a potential upside of 125 to 188 per share. Now, stock number 6 is Corsair Gaming. Now, Corsair makes high-end gaming and performance hardware and computer hardware for gamers. So for example, things like pre-built and custom gaming PCs, power supply units, cooling solutions, keyboards, mice, etc. They have a huge fan base with 2.8 million Instagram followers and a really active subreddit with around 100,000 followers. When we look at their revenue and profit, we can see that they only went public recently, so we have limited data, but revenue has really jumped a lot, doubling since 2019. And over the last year, they have been profitable. When we look at their balance sheet, we see a very healthy company with around 1.3 billion in assets to 80 million in liabilities. This leaves them with about 500 million in equity. Their debt is only around 309 million, so a little over half of their equity. When we look at the current projections going forward, we do see that growth is projected to continue on, growing from 1.9 billion in revenue and 119 in profit to 2.1 billion in revenue and 173 million in profits by 2023. Now, looking at the revenue growth going forward, their current projections are for them to continue to grow between 5 to 10% over the next few years. Now, if we use those growth rates, this comes out to a fair PE value between 13 to 22. Now, when we look at this valuation charted out, this puts fair value between 24 and 40 per share, up from the current share price of 20. Now, I know this doesn't look like it's as much upside as the others, but this stock has fallen a lot since November of 2020. So I'm thinking that if it does continue to fall, you might be able to get a really good business at a good discount. Now, again, remember that this is the best time to get into stocks, when the whole market is down and everything looks really scary. You really have to think of this as businesses going on sale. Now, if you were looking to buy a house and the whole housing market came down by 20% tomorrow, you probably would be pretty excited to get that house that you wanted for way cheaper than you expected to pay. And the reality is, stocks are no different. And before you go, make sure you check out this video I have for you next. And as always, thanks for watching.